In this market update, I'm going to be talking about bonds and how interest rates impact the price of bonds, as well as what an inverted yield curve means for the future. Hi, Jim Gore from THOR Wealth Management. People don't understand how bonds move with interest rates, so I want to explain that and also explain what is happening with the inverted yield curve. First of all, if you look at this chart here, this is looking at a fulcrum, if you will, with two sides of the fulcrum, or what I like to say is a seesaw. And on one side you have interest rates, the other side you have bonds. And the further you go out on that ledge, the longer your maturities are in your bonds. So if you look at that chart, what happens when interest rates go up, if you look at that, you'll actually see bonds go down in price and shorter term bonds go down, but not as far as the ones that are longer term maturities. They're at the end of the seesaw. And so those goes down a lot further. So you have to really understand your bond price can be impacted by interest rates. Now, if you own a bond a long time, if you buy a 10-year Treasury, you'll get your money back in 10 years. We're talking about the price will go down. If you bought a bond, a 10-year Treasury 2 years ago yielding 0.8%, there's no way I'm going to pay you $100 for the same bond when I can buy one from the Treasury that's yielding 4.5%. So I'm going to give you less of a value for your bond. And that's really showing up in the numbers. Since March of last year, when the Fed started raising interest rates, you can see what has happened. And this is looking at just the price of the bonds, doesn't include income. It's just the price of the bonds. And we're looking at three indexes, and we're all using treasuries here. So it's the same type of securities. So you can see here that if you had the 1 to 3 year Treasury ETF, the iShares, you're down 3.58%. You go out further in maturity, you go to 7 to 10 year Treasuries, you can see since March of last year, so the last 18 months, you've lost 14.4% of your portfolio. If you had 20 plus year Treasuries, you're down 29%. What does that mean? If you went ahead and bought a 20-year Treasury back in March of 2017, you paid $100 for that bond. Today, you would get $70 for that bond. That you're going to get a 30% reduction in your price. And that's what people don't understand about bonds, is that there is a risk out there with interest rates going up. Now, the other thing that we want to look at is what is actually happening within the bond market. And it's very interesting. This chart here is looking at the yield curve from 2 years ago compared to the yield curve today. 2 years ago, we had what is known as a normalized yield curve. What did that mean? Short-term rates are lower than long-term rates. That is normal. Think of it this way. A bank is not going to borrow money from you, pay in your checking account 2%, and then lend it out at 1%. They're going to want to go ahead and get a higher rate of return. They charge more for their loans. Well, right now, actually, you can see we have what is known as an inverted yield curve, which is looking at bonds shorter term are yielding more than longer term. And when you have a yield curve like this, it usually leads to a recession. And the reason for that is because banks won't be lending out money. They're paying people right now 5.5% for their savings accounts right now. They have to lend it out more than that to make money. So if they're buying treasuries, they're taking your money and buying 5.5%. They buy a 10-year treasury, they're only getting 4.3%. They're losing money. And that's what happens in an inverted yield curve, and that's why banks stop lending money. Now, there is something that's strange with this inverted yield curve, and this chart here is looking at the history of the yield curve and when it has been inverted. And over the last several decades, there's been 5 times that the yield curve has been inverted. And you can see that the longest one before now was back in 1988 to 1989. It was inverted. Now, these are just trading days. Keep in mind, that's only 5 days out of a week. So if you did it for a calendar, it's much longer than this. 96 trading days in 1988 to 1989. Notice here, the next two I think are very important. Back in 2000, 1999, 2000, it hit 0 in 1 day. It wasn't inverted, but actually it was flat. So that meant that the 2-year and the 10-year and 30-year were yielding the same. And 2006 and 2007 was 25 trading days. Why are those two important? Because those two dates, if you look at it, the yield curve inverted and actually started to normalize before the economy went down and the stock market fell. Look at where we are right now. The yield curve has been inverted for 350 days. There has never been a time like this where we had an inversion like we are right now. So this could, especially at a time when the THOR is over 70, this is telling you that there is a risk out there, especially in U.S. equities at this time, because this inversion, being the longest it's ever been, means that the market is going to correct and usually corrects stronger than it would, because this is the longest time we've ever been there. It is an unusual thing that we're seeing right now in the bond market. Now, the bond managers that we work with, and I got to tell you, bond managers are way smarter than equity managers. If you want to meet the sharpest people I've ever met in the world, they have been bond managers. They're very sharp individuals. And if you look at what we do here at THOR, we look at two things when we're looking at investing our clients' bond portfolios. First is duration. Are we going to buy 1 or 2 year treasuries, bonds, or are we going to buy 20-year treasuries? And you can see that duration right now is more positive to be invested in. Then we look at credit. Credit is, do I want to own a treasury where there's no credit risk, or do I want to buy a corporate junk bond fund that may not pay me back? So right now that's negative, which means that you do not want to lend out to entities that may not be able to pay you back. And what's interesting is both of these indicators, if you went back 2.5, 3 years ago, they were both in the -2 territory. And we didn't look nothing like the bond market whatsoever, because it didn't make sense to us to go ahead and buy a 10-year treasury yielding 0.8%. That was just too much risk of interest rates going up and impacting those bonds. Right now, we are longer in duration. That actually switched over in about September of October of last year. We actually added a bond fund to our client's portfolio, and we knew it was longer duration, and we wanted that bond fund to be longer duration. It's one that we actually reviewed, did our analysis, and approved it about 3 to 4 years ago, but it wasn't really until last year in September or October until we put it in the portfolio when we were getting paid for taking some duration risk. If you have any questions or concerns, especially about the bond portion of your portfolio, please reach out to us at THORwealthmanagement.com or give us a call. I look forward to talking to you in a couple of weeks.